And right now, we're more than double the all-time average. Deficit, how it works, what it means. The rate of negativity, which is a good thing, is declining. Hey everybody, welcome. My name is Matthew. Today we are finishing up our series on the United States national debt. I do encourage you to take a look at the prior exhibits, the prior videos, where we went through a variety of indicators, looked at the deficit, taxes, interest, and of course printing money as a percentage of taxes, as a percentage of the debt. Finally, today we're going to put it all together, and I'm going to give you a broad overview of the couple indicators that I think are most important to see where we are today. All right, so instead of using the whole 200-year history, we're just going to use a 100-year history of the debt going back to the founding of the Federal Reserve. That is the nation's money printer. Here we have, and this entire chart that I'm going to show you today, to sum it all up for this session of the United States national debt, is everything as a percentage of $1 tax, or cents on the dollar. The very last indicator will be a balance. That's a balance, dollars on $1 of debt, but I'll explain. Regardless, cents on the dollar right here, and this is the deficit itself. All right. So most important here, this is the deficit. So in this chart, if the deficit is positive, that's bad, and if it's negative, that's good. That's a surplus. Okay. As you can see, most of the time, the United States runs a deficit. Okay, it's very bad. And you can generally see that, except for the Great Depression and moving into World War II, as well as World War I, the deficit has been mild to increasing, let's say, over the last 100-year history. Bill Clinton tried to balance it here in 2000, the end of his term, and he did balance it accounting-wise for a couple years, end of his term going into Bush. But then with the Iraq War, Afghanistan War, global financial crisis, the deficit has been skyrocketing again. This is a flow, all right? This is trailing 12-month numbers, cents on every dollar received in tax. All I want to show you in a very simple form is the all-time average. Here it is right here, all right? 28 cents on the dollar is the deficit, all right? That means that the spend is $1.28, okay? Because they receive $1 in taxes all the time. The government, on a per dollar basis, you have $1, but they're always having a deficit of 28 cents above that. All right, that's what you see here. And where are we today? May 2024 balance 68 cents on $1 tax. That means for every dollar the United States government receives in taxes, it spends 168 for a deficit of 68 cents. That's the rolling trailing 12-month figure. You can see it's been quite high during the QE times, post-GFC, very high during COVID, off the charts, 121 cents. And right now, we're more than double the all-time average deficit. We're more than double the average deficit, about 2.5 times the average deficit, where the average deficit is 28 cents on the dollar of taxes received. Right now, America has a deficit of 68 cents on the dollar. Moving on, let's look at interest. This is the other big ticket item that directly relates to the debt itself. Cents on the dollar, what is it? Only have interest going back here to the Great Depression. Nonetheless, you can see it's a little bit less than the all-time average for the deficit. Interest is included in the deficit, is included in the total spend, of course. It's a cost of the debt itself. What's the average? 20 cents. 20 cents on every dollar of taxes. So if we just look at that here, and let's go ahead and take off the reds just to see where we are here. Interest, right now, 21 cents on the dollar, trailing 12 months. The average, 20 cents. Actually pretty normal. Pretty normal. I'm not saying this is a good thing that interest is $1 trillion if you look at the gross figure, but as far as cents on the dollar of taxes, pretty normal. Now let's move to the print. The print is the very emotional thing. That's the thing that devalues the dollar itself. You get nice pictures like this. The United States Federal Reserve and any central bank today, they're going to bring money into existence primarily, not always, but primarily by buying the nation's sovereign bonds, the nation's government debt. So let's look at what they've been doing here. Green generally is quite a bit lower than blue as far as cents on the dollar that the Federal Reserve prints on a rolling, ongoing, trailing 12-month basis. Let's take the blue off again. Typically pretty low, but of course, other than Great Depression times, World War II, we have what we'll call here QE 1, 2, and 3, and then of course the COVID madness of spending. As always with this chart, it's better to be negative here. It's better to not be printing, or in fact have a negative print that is removing base money from the economy. That's what they're doing right now. That's what they're doing right now. They're removing 19 cents for every dollar of taxes. The Federal Reserve is removing 19 cents of its own money from the books. It's buying less government bonds, letting government bonds roll off its books. What's the average? Trailing 12-month average. Pretty low itself as well. Average is only 5 cents, okay? So what does that mean? That means ongoing for every dollar of taxes that the government receives, okay? That's the income side, the taxes. When they spend, all right, we know that they spend $1.28, but how do they sort of finagle the system a little bit, help them out? They print money, of course. They print money, and how much of the money print is it? It's lower than perhaps you might think. On an all-time average, the entire history of the Federal Reserve, nation's central bank over 100 years, it's only 5 cents on the dollar, okay? And now, as we see, it's negative, all right? Although the rate of negativity, which is a good thing, is declining. You can see it was about negative 21 cents, let's say a year ago, negative 17 cents, and as of last fall, negative 21 cents. Now only negative 19 cents on the dollar. All right. Finally, let's look at the print balance. Okay. That's going to be in black here. This is the summation of all of these trailing 12-month prints. Okay. So you can see here, Federal Reserve really held no United States government debt at the beginning. Look at the balance now, the black line, 0 cents. And here, this is where it says you're going to have to switch your thinking with the balance, the black line. It's not per dollar of tax, it's per dollar of the debt itself. Again, just really hones in on the important figures. Great Depression, as I've said many times in prior videos, the United States did print a lot. 52 cents on a trailing 12-month basis took the balance up to 9 cents on every dollar of debt the Federal Reserve owned. Vietnam War height and got to 18 cents, went down, even way low during the global financial crisis, corporate bailouts. They took government bonds off their books, but then of course they had to put them back on because they printed a lot of money to bail out all of the mortgage-backed security holders. So QE 1, 2, and 3. And so here you can see, again, what are you looking at? The green is a trailing 12-month run rate of the printer relative to taxes. So very, very high here. And then the black line is the balance. That's how it works out. And as you can see here, they weren't printing any money at all from 2014 all the way to the eve of COVID. Did have that repo spike in September 2019. But when COVID happened, of course, the money printer exploded again. And then again, they're trying to taper it off. So again, just looking at these print indicators, the all-time average on a trailing 12-month basis, print as a percentage of $1 tax is only 5 cents, all right? And the Federal Reserve is removing money from the economy at the moment. They're removing money. They are not printing money. They're taking money out at a rate of 19 cents per every dollar of taxes. And that means the balance of the United States Federal Reserve's Treasury assets on its books, or as a total of every dollar of government debt, is 20%, 20 cents on the dollar, the black line. And then of course we have the exponential regression to show where that historically has been. We're not going to use all-time averages here. We can put a trend line to this one because this is a balance. It's a stronger thing. If you go out to the end of the decade, theoretically, they could get up to 27 cents on the debt, no problem. They were up to, look here at the black line, they were up to 25, 26, 27, 28 cents, remember, on the dollar, black line, in end of December 2021. And then they tried to pull it back down. And of course, pulling it back down on a trailing 12-month basis is the green shaded area. Taking a moment to remind you that this show is brought to you by Trezor, home of the original Bitcoin hardware wallet. For over 10 years now, Trezor means business in Bitcoin security and functionality. When using their wallet software Trezor Suite to connect to the Bitcoin network, you're automatically connected via Tor, protecting your identity and giving you full control of your coins in a fully open source manner, both on the software level and on the hardware level. So head on over to Trezor.io to grab your brand new Trezor Safe 5 with a secure element, as well as a ton of available accessories to back up your keys and keep your coins safe. So to conclude, as far as what the Federal Reserve does with government bonds, it's doing a good thing right now. Again, I'm not defending the Federal Reserve. I'm not defending the existence of the Federal Reserve. I don't like money printing as much as the next person, all right? I don't like the devaluation of currency as much as the next person. But theoretically, right now, they are not money printing. Not even theoretically, in practicality, they are not money printing. Both on a trailing 12-month basis and the balance, you can see it is falling down. Okay, so to sum it up, we have these print indicators, both cents on the dollar of tax and cents on the dollar of debt, the balance that the Federal Reserve holds. These are actually looking pretty good. I'm not saying that they won't very soon have to go back up because of structural indicators in the economy, but if you just looked at this indicator, they're actually pretty good. They're going down. They're in the right direction. All right. If we looked at interest, all right, interest is a constant thing. Let's look over nearly the last 100 years of interest payments. It's about average. About average, even though it's a huge number nominally. We talked about it. Over $1 trillion, it's going to be 3.2% interest rate. As far as cents on the dollar of taxes received, it's about average. And then, of course, the X factor is the deficit itself. Put that in red here. Let's even put the average on so you can see all the lines on the screen. The deficit itself is certainly the X factor, and that doesn't look great. Okay, didn't look good post global financial crisis. For 6 years, hasn't looked good during COVID, and even now it is growing. It is growing. So even though the Federal Reserve is printing less, they literally are. Let's get right on May here to finish the video. They literally are printing less money every month. The balance of federal debt, the Federal Reserve, the nation's money printer holds, is less every month. The deficit itself is increasing. And what does that mean? That means the national debt, of course, will increase. The national debt is just the summation of deficits. So as you roll this along, you see these trailing 12-month deficits. We're 2.5 times the national average. We're not printing money to make up for those deficits. So those deficits, how are they covered? How do we cover the government spending in excess of taxes? We borrow it. The United States government continues to borrow it. It continues to borrow and sell bonds into the market, but not to the Federal Reserve at the moment. It does not, on balance, sell them to the Federal Reserve. It sells them to foreign creditors. It sells them to domestic creditors. So this is as far as I want to take this United States national debt history. I do encourage you, if you like this, please check the prior videos, all the videos in this playlist. In this section, we go through point by point, item by item, the tax, the spend, the deficit, the interest, the money print. I've tried to put it all together here. Remember, economics is not a hard science. This is not supposed to predict when the next crisis would happen. But if you look at some of the buzzwords, interest rate, money print, those things are actually moving in the right direction, or not horrible at the moment. We do have low interest rates at the moment. I don't dispute that. And when interest rates go up, that will be more problematic. But as far as those items, they're not necessarily out of historical norms. In fact, they're even better than historical norms. It's the deficit itself that continues to increase. The national debt itself continues to increase. And that's why people say that there could be a debt crisis. We'll see. I'll revisit this in the future in other indicators. But for now, I hope this helped you get a big picture, bird's eye, broad view of what the national debt is, how it works, what it means, and how taxes, spending, interest rates, and money printing factor into it. That's all for now. Thanks for watching.